All right, so we are good to go. Um, so the first question says, put yourself in the shoes of Brentwood Associates management. You must decide whether or not you will exit Zoe's Kitchen now, and if so, what is the best exit option? As a group, vote what should Brentwood do with Zoe's Kitchen. IPO now, sell with a strategic buyer or financial buyer, or wait to and grow the business until it is more valuable before exiting. So what was everybody's
Um,
thoughts?
well, I was stuck between sell to a strategic buyer or a financial buyer, or wait and grow the business. Um,
Same here.
but I think I would lean more towards the wait and grow the business until it is more valuable before exiting. Because I feel like the Zoe's Kitchen is still a small company and it's still trying to grow itself. I mean, it's not compared. It's not an Olive Garden or a Red Lobster. So
Yeah, and Andrea, did you have the same opinion or something different?
I was leaning towards the fact that they should wait and grow a little bit more before they do that, just because of how big of a process it is and how it takes several months. And in that readiness survey that they did, it shows a couple weaknesses that they still have, some strengths too. But I just thought it'd be wise for them, especially since like their competitor, their Noodles and Company, was a lot bigger when they launched, did the IPO. So I just thought it'd be a lot better for them to wait and work on those weaknesses and have, I guess, do the IPO with really high quality instead of just trying to kind of panic and throw it together right now.
Yeah, and that's right where I was at too. I said that they should wait and grow, but then I did also say that if that because one of the things it did say in the case is that um, Brentwood Associates likes to exit within 6 years. So they only hold on to their portfolio companies for 6 years, and they're at year 5 right now. So if they're unwilling to wait for another several years to grow the company, I think the best option is kind of what it said in the case study is get your cake and eat it too, of the partial sellout. So sell part of the company. So you're still in the company, you still have it as a portfolio, just not as much. And that way you are still getting some of that money out that you need for other investments and still being able um, to wait until the company grows bigger. I think that they should wait, but if they can't, then at least do it like a staggered buyout.
Yeah, that's what I put as my alternative too. And I think it's like the minority stake or stake out or something.
Yeah, exactly.
Just because that way, they're still waiting and preparing the company to do the IPO, but Brentwood can start to accumulate their money now. So.
And I think it would also be a really big risk if they lean towards IPO. Also.
Yeah, it said that it was a big risk for Zoe's and for Brentwood because I
Yeah.
guess in the case study it said that Brentwood has the only other company that they've done IPO with was Zuni. And so their reputation is still really, on the line with how successful that the IPO would be. So if it was a disaster, it would hurt them and Zoe's a lot.
I couldn't believe what the fees were doing an IPO. It said between 10 and $15 million.
Yeah.
That was only one set of fees, and there was legal fees and other things on top of that. Even,
Yeah,
I mean,
it
it
was
just
like
it seemed pretty premature to do that. I mean, yeah, I'm sure it was lucrative, but risky for sure.
Yeah.
Yeah, it said it was like $2 million a year or something to remain public.
Yeah. On top of all that,
Yeah, after the fact, it would be $2 million a year. And a lot of that is compliance with the Sarbanes-Oxley Act. So there are a lot of regulations for accounting that go along with that. And there's regular audits and other regulatory pieces that go into the Sarbanes-Oxley Act. And it does cost companies a lot of money to be able to keep up with those regulations. And so that's where that $2 million a year comes from, really, is keeping up with that and making sure they're doing their reporting correctly.
Yeah.
And that's also a big part of that IPO too. And and one of the other things that the reason I have never really thought that I would ever get to a point where I would do anything with IPO is the paperwork involved in that, the whole process. And so I had to do a business law class a few semesters back. And one of the things that was brought up was the fact that if you do not do your due diligence within the company, so if you don't double check everything that's coming through that's put on the paperwork for your IPO, anybody that's involved with creating the paperwork for the IPO, you can be held personally responsible if anything goes wrong, because you verified that everything was correct, even though you didn't do your due diligence. And so that's another piece that really is scary, is you could be held personally liable if you make a mistake somewhere.
So you better be an expert.
Yes.
Basically is what it comes down to.
Another reason not to just rush into it.
Yeah.
Yeah, I'm in that business law class right now.
Yeah, and I think it was a little closer to the end of the semester that we talked about that. But yeah, that was like one of those things where I was like, oh my gosh, that's crazy.
Yeah, that kind of stuff scares me to death.
All right, so it says, let each individual state their position. If you all agree at the outset, take a counter position. So it says, why would Brentwood want to exit now?
Well, they said that the IPO level or whatever was really good right now, like the market or whatever for it was really good, and had come up a lot since the Great Recession, and so they wanted to, kind of capture it while it was good but I just don't think it's worth it.
Yeah, and I think another part of that is what we talked about, where where Brentwood only holds on to portfolio companies for 6 years. And they're year 5 right now. So they basically, to keep up with what they have been doing, they've got a year to figure out how to get out and to exit and get that money back, or get their value out of it. And so I think that's why they're strongly considering it at this point, because it does take a year or longer in some cases to do your initial public offering. And so that's why I think they're addressing it at this point as well, is because that's in keeping with what the company has done in the past.
Yeah, that makes sense.
Yeah.
All right, so what are some reasons for holding for now?
I think just holding for now is, like they said in the case, a more mature Zoe's is going to attract a larger pool of institutional investors. So I think they're just going to be way more attractive, being bigger, being more put together, rather than just trying to rush it. I think that's actually how it would appear if they tried to do it right now.
Yeah, it said that they would attract the larger PE firms or whatever. And from my understanding with the case as I was reading it, you want someone like a really good firm to do that, because they do a lot of the legwork for you, don't they?
Yeah.
And so you want them to do it well, of course. And so I think that's another reason it would be worth the wait. And also that survey that they did showed that they had some weaknesses that they could work on.
Yeah, and I think it was really interesting too that that they said right after you launch, that's another big part where the investment or institutional investment banks and things like that become in really helpful, is leveling out the value, because sometimes it launches and then all of a sudden the value tanks, and that can really hurt the company as well. And so having a company that knows what they're doing to really keep that level after launch really is important. And so they really do need those bigger institutional investment banks to come on to really help them with that part of it as well.
Yeah, and I also think that because in the beginning Zoe's Kitchen wasn't anything else but a small Alabama restaurant, I think they've been trying to get rid of that idea of a very family oriented restaurant into making it at a bigger restaurant like the examples they said, Olive Garden or Red Lobster. And so I think that's one of the things that was holding them back.
All right.
Yeah, another thing that he talked about too was that they were concerned that their brand, or what would happen with their brand and dealing with those investors if they went IPO. They had a certain idea for their brand, and they were worried that in those negotiations it would just be destroyed.
Mm-hmm. Yeah.
Yeah, and I think that comes with having a more established company too. If you've got the establishment, you've got the proven results to the level of some of these other big companies, they're not going to mess with that as much. Where if it's a smaller company, they think they can improve on it, and then that brand just gets torn apart.
Yeah.
I'm looking at their menu again. That looks really good.
And one of the other things that stood out to me was the fact that they could really derail growth too if they focused on an IPO right now, because they have that momentum and that growth going, and then it could sidetrack the whole entire management team trying to deal with an IPO instead of focusing on the business and making sure it goes and grows according to the plan that they have now. So that's another thing that I thought about a lot was right now they're in that growth period where they're really focusing on trying to grow and to maintain the brand. And if they were to go with an IPO right now, it might derail that.
That's a really good point.
All right. So what can go right under each scenario?
Let's see. Well, if we go back to IPO, one of the things it mentioned could go right was it would really increase their visibility and would give them a source of capital to fund their expansion.
Mm-hmm.
Yeah, and those are things that I brought up as well, because they are at a point where they are trying to grow and expand, and it's either doing it with debt or with equity financing. And so their options really are to go to, what was it, GE financing and get more of a loan from GE financing to grow, or to go with the equity and sell shares or sell the shares of the company to get that capital to really grow the company. So I think that that's a big part of the deciding factor too. But I think that that would really help them, and it would increase visibility for the company as well.
Yeah.
Yeah, that's a major pro that I found too. I found that.
What about with doing the sell to a strategic or financial buyer? What can go right in that?
Well, with that, Brentwood gets their money. They get to exit like what they were wanting to do.
Yeah.
Go ahead.
Oh, I was going to say, there's a couple things. So they could basically have sold out in less than 3 months, and the cost would be right around $1 million versus that 10 to 15 plus $2 million a year. So it would be quicker, cheaper, and better chance for success if they do it that way too.
Yeah, and if I remember correctly too, going that route, it's more stable and they know what they're going to get, rather than with an IPO where it could fluctuate and change, and they won't know until the day before the actual IPO what they're going to get, because that's when the actual sale price per share is set, is the day before the actual IPO. So with going with the strategic or financial buyer, the deal is set out so they know what they're going to get right up front, and so it's more of a stable buyout, I think.
Well, yeah, it's completed a lot faster, and like I think it said around 3 months,
Mhm.
and
Yeah.
you wouldn't require as much management time and attention as the IPO does. And
Especially if they were able to do that partial sold off the minority. That's gonna sell. That's probably what I would want to do right there.
yeah,
Yeah, and
Having it too would be sweet.
yeah, and I think so. Going back to what the cost would be to do the strategic and financial buyer. So I think what it said in the case was that it was 1.5% and $1 million for the legal fees. So and when I did the calculation, so it's basically $2.5 million around there is what their cost would be compared to like 12 to 15 million dollars. So
Right.
there is a big difference there.
yeah.
All right.
Yeah, and I don't know if you also mentioned that, but it also said that it would have a greater certainty on exit returns. I think
Yeah.
I already mentioned that. But yeah.
Yeah, and so now with waiting it out, what can go right in that situation?
In which situation? The IPO?
Yeah, if they
It gives them,
wait out and do the
Yeah, wait.
IPO several years down the road.
in that time frame, they can really have a chance to re-examine all their exit options at that point too. I think that was one of the first, things that can go right that it mentioned. And then, like we already said, it's going to allow them to attract a larger pool of institutional investors, which is important if they want to get a good price down the road.
So with that same scenario, so waiting it out for a few more years, what can go wrong?
Well, the IPO level or whatever might not be as favorable as it is now.
Yeah, the IPO window could close and it could be less favorable in the future. So they could be actually losing more money by doing it the biggest thing. And I really that was the biggest one that I could think of, is that window closes. Really they won't recoup as much as if they did it now. And so that, I think, was kind of, I got a sense of urgency from the case just because of that fact. Hey, look, we're at a good point right now, let's do this, rather than wait it and see if it's going to change.
And their company could change too. Like right now they're growing and doing really well, but what if in a few years their stores start to not do as well, or and they're not able to expand as much as they wanted to, then it might be more rocky too. They wouldn't be as in a promising state.
Yeah. Yeah. And they did say that there were quite a few smaller companies, but still investors that were interested right now. And if you hold out, then you could lose the interest of those investors. And down the road, it may be harder to find investors that are interested in purchasing shares. So that is another part of it too.
Yeah.
All right. So under the strategic buyer or financial buyer, what can go wrong with that situation?
Well, in the case study, it said that valuations tended to be lower in the private markets than the public, and since they're in the private right now, they might not get as much money as they could later.
Yeah, that was kind of the only undesirable thing I kind of found in that situation. Everything else didn't seem as bad. But yeah, they aren't going to get quite as much.
Yeah, and I think one of the other things that can go wrong is if they choose to get out now. and then the company really does really well over the next couple of years, launches an IPO, they may kick themselves because of the return that they could get if they would have just waited.
Yeah.
Man, that is the battle right there.
Mm.
Get out now or stay in. It's who knows. It's a tough decision.
All right. So what can go wrong if they do decide to go with the IPO right now?
It could be a disaster. And that the company could, you know, be completely ruined, really, and Brentwood if it doesn't do well, because their reputation for both of them, you know, they're good right now, but they're kind of fragile, so it could be a disaster.
Yeah. Yeah, and I think we talked a lot about it. So they could get sidetracked as well and could really stifle growth. But there's a lot of things that could go wrong. They could completely devalue the company too, because that's one of the things it said is if you start moving forward with an IPO, there is I don't remember what the specific law was, but there is the law for new growing. I think it was growing economic companies or something like that, GEC, where if they can in private begin the filing process, so that all of their information isn't made public, and by doing that they do protect themselves against the possibility of fallback from beginning an IPO and not finishing it. So they do have that protection at least, but it really can hurt both companies, I feel like.
Yeah, their private valuation would be hurt because then they'd be seen as a tainted asset.
True. Oh yeah, true.
And then the future buyers would doubt of what they've done.
Yeah, and that is the benefit with I think it's the GEC, is that information doesn't have to be disclosed, that they tried to do a public offering and then stopped. So in that instance, it wouldn't taint them. It's just if they get past that and actually go with the public filing that's actual public, that they would be, that they would get, their valuation would be tainted. So they do have some protection under, I believe it's the GEC Act. But still, that should be a worry. All right, so how much is Zoe's worth under each option? Discuss with each other how you got the answers, and as a group come up with a consensus as to what Zoe's is worth. All right, so did you guys do like a spreadsheet or valuations?
I did, and I am looking for it. Where is it? Go back here.
So I'm going to go ahead and share my screen real quick so you guys can see. We can talk about the spreadsheet that I did and see if everybody else got something similar or different.
Yeah, I'm just trying to find mine real quick. Where did I? Did not save it in the folder for this class. That's stupid.
I do that all the time.
There's B83, B383, 483. It's all these B's right now. I'm like, oh gosh, it's so easy to throw it in the wrong folder on Dropbox. Shoot. I'll keep looking.
Can everybody see my screen?
Yeah.
Mm-hmm.
Yeah.
All right, so the numbers I got up here, so you can see the 27.6. So that was the average multiplier of the earnings before interest, taxes, deductions, and adjustments. This was the number that was listed in the case study for, what was it, 2013? Yeah, 2013. So this was the number that they listed for their earnings before interest, taxes, deductions, and adjustments. And so, based on that, an IPO of 27.6, which was the average, would put the company at worth $311 almost $301 million.
Oh,
And then on the strategic buyer, because it did say that the average for strategic buyers were slightly higher, so this was the average on that one, and it's 10.2. So if you multiply the interest or the earnings by the 10.2, you get $111 million. And then the financial buyer, the average was a multiplier of 8.2. And so I got 89,371,000. And then I just took the average for the cost to sell on the IPO, which was listed at $13,700,000. So that gives us the total they would earn off of the sell for everybody. The total equity would be $287 million. The strategic buyer would be 108, and then the financial buyer would be $87 million. So that's the information I got. What did everybody else get?
well, I didn't. I was working on this case late at night last night, and I had a hard time coming up with how to do the valuation. But so yeah, that actually helped me a lot to see how you did that. So I'll know for next time. Sorry.
Oh no, you're fine. Did anybody come up with anything different, Kip?
I'm looking for that. I don't think with the multiplier, I don't think that I have that same number. I trust yours heck of a lot more than mine, though. I'll tell you that.
I don't know that I would do that, but
I've got faith. I'm gonna have to do this. That sucks.
Yeah, I tried, but your numbers are close with mine, but it's not really the same thing. But I don't trust mine either. So
yeah, and that's the thing, is everybody can get something different because there were a lot of different numbers listed.
yeah.
And so I was like, well, which one do I use? Because there was one that was the growth was very similar, but it was just a little bit lower than that number. And then there was the average. So I'm like, well, really, which one do you go with? But I decided to just go with the average on the multipliers. So
you calculated your own average, right?
no, I went with the average that was listed.
Okay.
Which was in Exhibit 7?
I believe that's what it was.
Yeah, it was. Yeah.
But yeah, I just took the averages from there, and that's what I used.
Okay.
All right, so let's look and see if there's anything else that we needed to do. Okay, so what differences did you observe in the valuation based on who buys the company? And does this make any sense? So the biggest difference is going to be obviously between the private purchase and the public sell, which the private is going to have a lower valuation than public because of the amount of people that are purchasing at a public work compared to a private. So private, you're really just selling to a small, or to one or a smaller number of investors, where with a public offering, you're selling to many, many people, and you're making it basically available to anybody that wants to purchase shares in your company. So that is where the difference is. And then between the one that I didn't really understand was between the strategic buyer and the financial buyer. So I guess because the strategic buyer does have a higher purchase price. So I guess really I don't understand what the difference is between a strategic and a financial buyer.
I didn't either. I don't even. I'm gonna have to research what those both mean, because to me they seem like they would be the same.
Yeah, that's the one thing I didn't understand on that, and why those would be different. But
the other thing, yeah, so a financial sponsor or a strategic buyer. I wasn't quite sure what the difference was there.
yeah. Yeah, and then the last question says, why would anyone sell to a financial buyer instead of doing an IPO?
Well, I think that goes along the reasons why we didn't choose the IPO.
The cost and
Cheaper
how
to
complicated.
do it. It's faster.
Faster, yeah.
Better chance for being successful with it.
Mm-hmm.
Yeah, and and like Paulette said too, you know what the valuation is going to be at the outset of it. It's also quicker. So if you're needing that money quickly to invest it in another company, then that's obviously going to be your better option, rather than keeping that money tied up for several more years or for a longer period of time. An IPO is more unstable, so you don't really know what you're going to get. So there is more risk involved with that than to sell it to a financial buyer. So those were the reasons that I could think of.
Yeah.
Yeah, and it's hard to say, because there's people that are so versed with the quick food business like this, or the sit down restaurants, and they might look at their concept and be like, oh, it seems really good, but I see this tanking out in a couple of years. So it's hard. Like, you might think our concept rocks, but other people might look at it and just, you might put it up there and they just might not even be that interested. It's hard to say.
Mm-hmm. Yeah, and that's where the risk in doing a initial public offering is it may not perform as well as you think, and that would drop the value of your company instantly, and automatically from the get-go would hurt your company.
Oh yeah, you would be tarnished after that.
Yep.
Yeah, and they even mentioned that they would rather build a company-owned stores, like to have a company-owned store as a Zoe Kitchen, rather than build a franchise, which I thought was interesting, because at first you would think that you would want to turn this really good concept of a food and like project into a franchise, but no.
Well, and I think the big reason for that is they didn't have the structure set up for it. So I did in one of my entrepreneur classes, we looked at the difference between franchising and starting your own company. And one of the biggest things is that there has to be that support there to do a franchise. And so a lot of these companies that have company-owned stores and franchises, they have a separate division that just oversees the franchises. They have a director of the franchising to give the support to the franchisees, and they have a full network and a full company basically that they build just for the franchising. And at this point, they don't have the resources to do that. And so I think that's why they're kind of shying away from the franchising at this point in time, is just because they don't have the resources to devote to making those franchises successful. And if they were to go with the franchising, then it could hurt the brand overall if they don't have the support there to support those franchisees.
Yeah, that's true.
Yeah, if you're selling franchises and they're failing, that's worse than I think that's worse than your IPO not appraising for what you think it should be.
Yeah, that's
It's
true.
like,
But,
All right. So does anybody have anything else to add?
no.
I don't think so.
Okay, so in conclusion, we all felt that the best option would be for them to wait it out until the company has grown a little bit more and has increased in value before they exit. This will allow them to really go to really harness the momentum that is currently going within the company. There are definitely risks involved, such as the IPO market dropping to where there's not as much value in doing an IPO several years down the road. But we all feel that this is the best option for them, is to really wait it out.
Yeah. Yes.
sounds good.
Yep, sounds good.
All right. So I'm heading off to another group meeting, but I will try and get that posted here in the group discussion board here in just a couple of seconds before I head to my other group meeting. So it should be there, and then I guess we'll plan on next week. So I'm going to stop the